Okay, everybody back? Good, okay. All right, I was thinking about the announcements. I forgot to mention, I talked about the class. Boot camp is going to run right through, I think the last one's going to be on Father's Day on the 17th, because that is 1 week before the New Jersey live class. So what I'm going to do, and then obviously there won't be one on the 3rd, which the web class will be going on. So that'll be like a review class. Use that as boot camp. So we got about, I don't know, 5 or 6 more. Let me see where we're at. Today is the 29th, so we got, I guess from today we got 5 more boot camps. What's going to happen is we have the 6th, 13th, and 20th. The 27th is a holiday weekend. There's not going to be boot camp. That is Memorial Day weekend. And I think a lot of people are going to be going away for the weekend, right? Saturday, Sunday, Monday, extended weekend. So no boot camp on the 27th. Don't worry, I'll announce it again. And then we got the web class on the 3rd. And then boot camp on the 10th and 17th will be the final boot camp. And then on the 24th, I will be live in New Jersey. And then that will be, we'll take a break probably for July and August, and then we'll start September 1st. Right after Labor Day, I'll start another cycle. That's what I'm thinking. All right, if that sounds all right, let me know. This way you guys can enjoy the summer, go back. And, oh, the recordings will be left up. The boot camp recordings will be left up. So you have a chance over the 8 weeks to go back and redo the cycle. And then in September, we'll start another one. Okay? And we'll run that September, October, right up to about Thanksgiving, and then that'll be it for the year. Okay? So I'm going to run the boot camp simultaneously with the web class and with the live class. I will stop the Sunday before, which happens to be Father's Day, will be the last boot camp. Okay? That's the plan. That's what I'm thinking. If anything changes, I'll let you know. The other thing, too, is we're going to have some meetups in between here and there. Probably have the Dallas one might happen. I was talking to Ray and Carr. They're talking about going down there with Casey and hanging out. We'll get it figured out, man. But bracelets will be on hand over there if you guys are in that area. Okay. All right. Let's get back to work. Yep. The recordings are staying up, man. I'm not taking any recordings down. They're up. That's it. They get stolen. They get stolen. That's life. You're going to have the boot camp opportunity, and you're going to have the class itself up all the time. Okay? That's the plan anyway. Yes, Moshi, the answer to that is yes. Peter, yes, thank you. Okay, man. Let's get into some of this other stuff. All right, let's talk about moving averages. Got about 45 minutes left. Take a breath. Hope your break was good. And we'll go from there. All right, here we go. The averages are one of the most common elements of any system, okay? Ask anybody and they have moving averages on their charts. Since they're so common, market makers will fake to these areas. You can use them to identify levels and market maker trend cycles, intraday or over the course of the week. Here's what I want you to understand. One of the questions about moving averages is this. How do you know when the dealer's going to bounce off it or when he's going to penetrate through it? It's a fair question, right? Okay, so here's the answer. If I could just get a pen. Okay. Here's your intraday pattern, right? If the dealer breaks high and makes his M formation and the averages are laying right here, if this happens to be 3 a.m. and that's the stop hunt vector for the day, he's going to penetrate the averages. Okay, you can't see the color yellow. Let me see. Back to black, okay? If the dealer breaks at 3 a.m., makes the M formation, the averages happen to be right here, turning over, most of the time the dealer will penetrate the averages after the stop hunt's been made. Okay? But if the average is down here, let's say the 4-hour or the 200, the mayonnaise is down here, chances are Depending on the timing, if this happens to be 9 a.m. when he makes it here, he's going to bounce. Or he's going to spike slightly past, make the formation, and end back here with the pattern. Okay? The averages are used by traders as a signaling system. Okay? Like, I don't know, some people use the 20 EMA or the 20 SMA on a 15-minute chart, and when the dealer penetrates the 20, they sell. On the downside, when the dealer penetrates the 20 on the upside, to the upside, they buy. That's a system. I didn't say it was a good system. I just said it was a system. The dealers know this. They know that people trade these because orders will be aggregated on either side of this, or the stop loss levels will be placed above or below here when people actually take the trades. So that's why you'll see a lot of this crap, a hesitation or a stall at the moving averages. The 200, the 4-hour, the higher, the bigger moving averages. So if the dealer makes the stop hunt, in essence, he crossed over the averages, right? Then he pulls back. The chances are that if it's early in the market maker cycle, the dealer will penetrate the averages and just go about his daily business. If the averages are at or near the end of the cycle or the end of the day, the dealer will consolidate to that average. Does that make any sense? I need to make a slide for this. I've just been thinking about how to say it. And I need to make a slide for this for the regular class. Okay? Here's what I mean. The averages are here. The dealer vectors past them. They will not hold. He'll penetrate the averages as part of the regular cycle, and he'll do his business. If the averages are here or here, he will end the day consolidating at or near the average or by the average, because people will take this as signals at the wrong time of the day. They might see this at 3 o'clock in the afternoon and sell off of it. And then he'll rise price and end the day in here. Okay? That's what I want you to understand about the averages is important. Can you use them to identify levels in market maker cycles? Yes. But I don't want to focus on that right now. I just want to talk a little bit about them. Okay. We use EMAs. Any particular reason? No. When you look at the TDI, the way the TDI is set up and weighted and the way the ketchup, mustard, and mayonnaise line up, it just made sense to me to use EMAs. The signals are still there with SMAs. It's no worry. Does it matter if it's 513, 515? No. We don't use the averages to trade. We use the averages to confirm direction. If you don't like them on your chart, squash them. I'm not offended. Okay? Exponential moving averages simply means, and to summarize, is that more weight is placed on current price action. Well, if I'm a true believer in what the dealer is doing with the current price, I don't care about last week's price or yesterday's price. I care about the behavior the dealer is doing right now. So it makes sense to me with my little peanut brain that I should place more weight on the current price. So that's why I like exponential moving averages. The settings we use in class and in this group are 5, 13, 50, 200, 800. I don't think we have a good name for the 800 yet, and if anyone's got an idea, I'm all ears. But we got mustard, ketchup, water, mayonnaise, blueberries. I wish I could think of a blue condiment. Does anybody know one that goes in line with these other ones? Because these are all condiments, and that's not. Blueberry? Okay. All right, here you go. Mustard, ketchup, water, mayonnaise, blueberries. Okay. Why is the 50 and the 200 used? If you pick up any textbook, pretty much, the 50 and 200 are mentioned in there. I think the Investor's Business Daily talks about 50-200 crossovers on the daily chart as their signals. Okay? Most institutional and bigger traders use these averages. I've read a lot of trading textbooks, and I got to tell you, these averages are in there. And I mentioned 513 match up with TDI and give pretty good signals. But here's what I want you to understand. And this is the part that I need you to trade strong, to use your bracelet and find the power within inside yourself. No indicator can replace your ability to identify the pattern in the count. Period. Oh, he went to the average, but he made an M or W. It doesn't matter. The pattern, the pattern, the pattern. Okay? So the TDI, pivots, all this other stuff doesn't matter. It's what the dealer, how the dealer handles the high and low of the day and the low and the high of the week is what matters. Because he moves to these levels based on where the accumulation of bank orders, retail trader orders, their stop loss orders are sitting. That's all he cares about. You know, you guys obviously know Compass. A lot of you came to me through Compass. A lot of you know who Brian Rich is. He's a guy who works at a desk. Okay? And he's willing to break the silence, and he will verify everything I'm telling you. No amount of studying the wrong thing on a chart, looking at moving average crossovers, no amount of that will make you successful in the business. What's going to make you successful in this business is understanding the deeper meaning of the pattern that I'm teaching you and why it happens. Okay? Why did the dealer shoot up straight 60 pips and make an M? Triggering the stops of the retail traders that were short, defending against the level of orders perhaps that were above that 60 pip run, hit the stops, pull back, induce traders to go long, hit their stops, get the shorts taken out, pick up the money, stay away from a retail block of orders that are at a price point or support and resistance or whatever the level is for whatever reason, a buildup of money or volume, to trigger that order or to stay away from that order is what's really and truly going on in the business. The pivot points, the tracers, the averages, the TDI are not going to show you that. The only way to see that behavior is a true M or W formation on the chart. Because I've explained to you 100,000 times, and I'm happy to do it because this is 100,001, why the dealer makes that move. He makes that move because he is trying to pick up orders, pull back, take out the stops, induce the other way, hit him again, defend against a block of orders that's sitting up here that he might not handle in his book. This is why if you learn to identify this move, second leg, because the dealer has spiked and has failed to take out this block of orders or failed to release the long holders back into the market, this is how you understand that the trades are setting up. Doesn't matter if there's a 200 right here or a 4-hour or a pivot point or a blue tracer or a stochastics rainbow, a TDI, an RSI, a MACD. It doesn't matter. That's why working on the big board, when the dealer spikes the high or low and pulls back, or spikes the low and pulls above, understanding he's working orders, it's constantly about money flow. Now, we have these indicators on the chart. Why? Well, Steve, if they don't matter, why the hell you got them on the chart? We have them on the chart because the retail group of traders that doesn't understand what we know in this business or in this group is because people take these as signals. And because they take them as signals, the buildup of orders will be placed above or below the 4-hour moving average, above or below the blue tracer, at the pivot level. The areas that we call strike zones outside of the ADR. The orders are built up in these areas. So the dealer will go to the M4 pivot and make an M formation and correct. He will go slightly above the blue tracer, yesterday's high, and grab some orders and correct. That's what you have to understand, and that's what I mean by this last line. No indicator can replace your ability to identify the pattern and the count, where you are in the cycle, what's going on. When I say the count, days of rise, levels of days of drop, I understand you're saying, well, I don't know, I don't really, you say not to worry about the levels. Okay, well, the count also contains, part of the count is, okay, stop on high, you're in the Asian range, the dealer makes a stop on high. This is part of the first part of the cycle, isn't it? Okay, pulls back, hits it. Level 1 correction, level 2 correction, level 3 correction. Okay? Doesn't matter what the averages are doing. What does this move do? He makes the M formation to work the orders above this area or in this area. Then he pulls away and he turns around and acts like he's coming back up. But in essence, he's hit the stops, drop, hit the stops, drop, pin to the downside. That's what you have to understand, how he works the areas, okay? Now, it's important to note that the 200 moving average on any chart represents the 50 EMA on the next higher time frame. What do I mean? If you're looking at the 200 on the 15-minute chart, the next higher time frame is the 1 hour. So the mayonnaise is the 1 hour 50. So if price is trading below the mayonnaise without looking at the 1 hour chart, you are in a downtrend on the 1 hour chart. You don't need to look at it. The 800, which is 4 times greater than the 200, right, represents the 50 on the 4 hour chart. So if you have all your averages strung out like this, I think I got a picture. It's better. Wait, let's see. Okay. Any trade that is counter to the market maker cycle must have a take profit at the watermark or the mayonnaise. Very important. You got to use a trailing stop in case the market maker deliberately holds price away from the average. Okay? This is what I mean. Okay, let's say this is the 4 hour, the 800, right? This would be the 800. It's not the 4800, it's the 4 hour 800. Okay, let me put a little dash right there. This is the 200. Okay, here's what I mean. If the market maker cycle is this for the day, right? Obviously, this would be your peak formation for the day. It could be part of the weekly cycle. Now, depending on where you are in the cycle, if the dealer breaks high and gives you an M formation, I told you trade both ways without fear. And you take this back towards here, and the dealer deliberately misses by holding off of the 4 hour mark by slightly above and then rises. If you did not adjust your stop or trail, you would take a winning trade and turn it into a loser. This might be, the distance from here might be 38 pips, and you want to take the risk and go for it. Okay? Again, end of the cycle, the dealer comes back, he might just miss the average. But on the bigger picture, the bigger cycle, this is the how, or the LOW, the low of the week. The dealer will make 3 levels of rise, let's say, intraday or 2, whatever. He makes his rise, makes the M formation, and then comes back to go into consolidation to end the day. And you take this short, and you keep holding it thinking it's going to pay out, and he just misses, and then he starts the next night where he rises. Okay? Understand? So if you shorted this, you got to figure out a way to protect this trade. You got to either trail your stop into the range as it's moving in case the dealer deliberately holds off the 800 or the 4 hour because there's some amount of orders built up here to trigger that if he breaks below to short, right? So he might deliberately hold off of the average. And what would happen is that would cause you to miss your take profit, and then the trade might continue on up if this is day 1 or day 2 of the cycle and he plans to rise tomorrow night. Okay, you guys with me? All right. Okay, so very important. Take profit at the watermark or the mayonnaise. Adjust your stop into the range as the dealer moves towards those averages in case he fails to trigger them. Okay? Well, black ain't going to work. Okay, hold on. All right, red. Okay, look. This is the moving averages by themselves with no price action. I want you to look at what's going on here. I want you just to see the same stuff. Picks up the breakouts, drops down, makes a nice shark fin to the mayonnaise, pins to the mayonnaise, right? And then he ends the day starting to rise, back in consolidation. Okay, same thing here. Dealer hits it, comes back, pins to the mayonnaise, continues to rise. Okay, you can see some of the same patterns with just the averages by themselves. Okay, when you start to notice them, they're in there. But I wanted to point out that the position of the mayonnaise on the 15-minute chart is the position of the 1 hour 50. And on the 1 hour chart, the position of the mayonnaise here tells you where it is on the 4 hour chart without looking at it. So I could glance at this chart right now and tell you, without looking at the 4 hour, without looking at the 1 hour, everything is trading above the intraday balance line, above its 50. The 50 moving average is known as the intraday balance line. Okay, right? Because institutions use a 50 crossing over the 200 as a signal. That's the intraday balance line, crosses the longer term moving average. That's an up signal in any system, perhaps. Okay? So without looking at all these charts, once you understand the relationship and understand where it is, you understand that I don't have to look at all these charts. I already know that on all three charts, 15-minute, 1 hour, and 4 hour, I'm in an uptrend. I'm trading above the 50s on each one, intraday balance line. I'm trading above those numbers. Okay? Okay, and it's just showing you 50, the 1 hour 50, 5 and 13. On the 1 hour chart, obviously there's the water, there's the 4 hour 50, there's your signal lines. Okay? By simply glancing at this chart, I know that we're in a downtrend. Okay? So like I said, just looking at the 15-minute chart, you can tell where price is trading on the 1 hour, 4 hour chart. Once you do your initial check down, it's not necessary to look at multiple charts. Okay. Keep your trading window open on your 15-minute, make your decisions. Now you understand the relationship of the averages, and you just glance at it, you know, all right, everything's in this situation. It's all trading below the 50s on each chart. 15 minutes enough for me. So now, you look at the 4 hour chart, you come into your office, you look at the 4 hour chart, you draw the psychological support and resistance levels for the week. If it's Sunday or Monday like it is tonight, look at the action from Thursday and Friday. Where did the dealer leave off? Is there a spike trap on Friday that looks like it will continue on Monday? Where am I in the cycle? Has the dealer been dropping like he did in Canadian and then painted a W and rise? And then paint an M and continue to drop? Those are the things you're looking for. Tonight, when you go into your office, draw your psychological support and resistance levels after the Asian session completes. First 2 bars, first 8 hours of the week. Now the dealer will exploit those levels. Okay? Go to your office. You're doing your check down. Come over here and you go first 8 hours. There's that line. There's this line. Price is trading in here. What do I expect the dealer to do? I don't know. Let's wait for him to do something. The dealer makes an M formation and breaks to the downside. And he settles in over here. Makes the peak formation low for the week. Now I'm looking for longs for a couple of days. Boom, boom, boom. I know that he doesn't do this perfectly all the time, but if you take a long near the low of the day and the low of the week, you're not going to fail. Okay? And I don't mean fall for the breakout move where he grabs the breakout traders, the small little move. I'm talking about a true deep stop hunt, 25 to 50 pips deeper than the blue box. Those are the solid moves that set up that do not fail. Remember my friend Zaim that did the research that said I was a liar? And he spent 4 months going back through all the charts, and he came to the conclusion that high 80s to 90%, that if you take an M or W formation that sets up exactly as I described over 8 candles, you have an 85 to 90% ratio of success. Think about that for a minute. That's just the perfect M or W formation. You have an 85 to 90% success rate if it forms out the way we're talking about. Okay, think about that. Now you add the TDI, the RSI, shark fin, filters, other things in there, you should be able to filter out the garbage. Okay? All right. Now, using the moving averages. Talking about the levels a little bit. I told you I was going to mention them later. Level 1 is identified by flattening and tightening of the averages. Okay? Good friend of mine who passed away used to say when the averages are flat, they look like spaghetti. You don't trade spaghetti, you eat it. Okay, so if the averages are flat like this, add some Alfredo sauce or some marinara on there, all right? The averages are flat, you're getting into level 1. Okay? What happened is there's usually been an aggressive move, they calm down, they pull back together because price is in consolidation. Okay, then what happens? The dealer makes his breakdown, the averages will follow a little bit and then start to loop around. And then when he's on his run, they will start to spread out. Level 2 can be identified by the little old institutional signal, 50 crossing the 200. Right? Water crosses mayonnaise, you'll usually get a pullback. Okay? That is called a 50-50 bounce trade, and I'll talk about that in another bootcamp session. Okay, so here's what happens. You get your formation, price starts to rise up, you get the crossover here, you get a pullback to the 50, stop hunt, low, rise, bounces off of that 50. Okay? Right here. Level 2 is identified by crossing of the 15-200. Level 3 is identified by a fanning and then collapse of the moving averages. The cycle starts with a collapsed bunch of averages, and it ends with a collapsed bunch of averages. Isn't that kind of coincidentally funny? I think it is. Why? Because the dealer always comes back into consolidation to end the day. And if you understand that, putting that to the averages, it only makes sense that the dealer will crush them together, expand them, open them, crush them back together, fan them out, collapse them back, and then end the day flat again, start the cycle over, right, the next day. So now let's look at it in a picture, okay? Look, crushed out averages. Wait a minute. God forbid I use red. Hold on. Pen color. I'm going to try yellow, man. All right, look. Check it. Okay, start of the day. 15-minute chart. Okay, price action breaks up to the high side. The dealer drops. Look at the averages starting to fan out. They were crushed together, starting to fan out. Okay, the 50 crosses the 200 right there. Notice how it made like a little W formation with price action. Then it continued its drop. Sideways action, continued its drop. Ends the day where the averages are fanned out. See how fanned out they are from the mustard? Look at the separation between mayonnaise and mustard. Okay? Some people don't like mustard mixing in their mayonnaise. They put mustard on one side of the burger, mayonnaise on the other. Look at the difference. And then they rinse it off with a little water. Look at how it's spread out. Price action gets away from the averages. It's standing off of it. You're getting closes outside the mustard. Then all of a sudden, look what happens. The low of the day is hit. it makes a W formation, and the averages start to string back together and collapse back together. Okay? The market makers are saying, look at that, price action has run too far away, time to put the brakes on, we're in level 3. They go into consolidation at this level. Notice, think about some of the things that I've talked about tonight. Draw a line right here. The dealer hits the low of the day, comes near it, fails to break it, comes near it, fails to break it. Once the dealer stops extending the low, it's time to look for the reversal, back into the range to end the day. Without seeing the candles, we already know what he did. Look, let's pretend, look. Without seeing the candles, there's your Asian range. The dealer breaks high, makes an M formation. He does this to fake everybody out. Then he falls off of a cliff, pulls back, hit the stops, drop. Hit the stops, start grabbing at the bottom, and then pull away to trap the lower level short holders to end the day. Damn, Steve, you drew that a couple times since I know you. End the day to start the cycle the next night, okay? So now, using that information with the pattern, you can clearly see the crossover, the peak formation high intraday, what we expect the dealer to do using the averages. Price is closing outside the mustard, outside the mustard, outside the mustard. You get too much angle and separation, to coin a phrase from red light, green light guys. The dealer establishes the low of the day, pulls off that low, and makes a couple near misses, and then starts his way back into consolidation to end the day. And if you notice, this happens a lot, he will rattle around between the 50 and the 200 to end the day. Why? First of all, because price action is averaging, it's coming back and averaging smaller ranges, I guess the right word is. It's forcing the averages. Remember how a moving average works, right? Moving average takes this candle, drops the last bit of information off, and adds it to the front. The next candle drops it off, drops this information off, and adds it to the front. It's averaging whatever the look back period is, okay? If it's 50 EMA, it's taking the last 50 averages, 50 prices, and averaging it, Xing off the last one, add it on. X off the last one, add it on. So the averages, by average, because the ranges in consolidation become tighter, it forces the lines to turn flat. So now because price is doing this and we're averaging the last 50 bars, it forces it to come tighter. So now what the dealer has done, he'll rattle between the 50 and the 200 and screw everybody up. Because what happens? Well, one of my systems is a 50-200 crossover. Another one of my systems is if he breaks above the mayonnaise, I take it. If he breaks below the water, I take it. Okay, what happens when he rattles back and forth in between both of them? What the hell do you take? It is very interesting because it's a trap. It's a trick. So when the averages come back together, the market is in consolidation accumulation phase. The dealer starts the cycle over, and he rattles between the two averages and screws everybody up. And then just for kicks, he'll rattle in the 4-hour right there, and he'll just be like this. He's between all the 50s. Think about that, how screwed up that is. He's rattling around between all the 50s, and people that use those for signals don't have a signal. Okay? So he'll rattle around in there to keep everybody confused. The averages are not a signal for us. The averages are a guide to help us see where we are in the cycle. If you take them off your chart, I will not be offended. The reason we look at them or look at this study is to have a rough idea of where the dealer may make an M or W formation. That's all. Okay, guess what? The dealer broke to the upside off of the 50 right here, and then he crossed back over with an M formation. Right? The dealer, notice he came to rest right around the 4-hour, rattled in there, made another W slightly past it, and then pulled away and ended the day, right? That's the same stuff I've been teaching you since you met me. The dealer snatched it away, showed a break to the downside, right? First he was below it. He pulled back. He probably got the stops of the people that were short in here. Then he went back over and said, oh, you didn't think it was short below the 4-hour? Ha-ha. Guess what? People went short. He pulled away, pulled away, Think about this for a minute. Okay, I erase this. Here's your low of the day, right? But for this little period, this is the low of that period. So that's a little baby W formation right there where he trapped some lower level shorts, came near it and didn't let him out. Same crap that he does to everybody else. Then he ends the day here. And what does he do? He has this whole group of traders trapped. He has this whole group of traders trapped. He looks at his book and he goes, I picked up 450 million on that move. I guess I need to run their stop, so tomorrow I'll just break high. That's what's going on in the business. This stuff is for us. It's for the retail people. These guys don't give a shit what the averages look like. Like candles and price action, the averages are a guide for us. There's like a footprint of where the dealer may go or what he's done. It's a footprint for us. I know this is like a perfect example where the averages are laid out perfect, but the dealer doesn't always do this. But I want you to understand what the mentality of the dealer is. That's what the whole business is about. What is the mentality of the dealer when we see these things on the chart? Think for a minute. I don't care about moving averages. I don't care about TDI. I don't care about RSI. I care about what is the dealer's behavior at these areas on the chart. Why is he doing it? That's what you have to ask yourself. That's what's going to be your aha moment in the business and help you turn the corner. When you realize, oh, a moving average crossover, should I take that? No, you shouldn't take that. You should already be in from the high or from the low. The moving average crossover tells us that on average price is failing if it crosses to the downside, or price is dropping or correcting. If price is rising and it crosses to the upside, on average price is closing higher or rising higher. But if you already took the pattern off of the M or W, you should already be in. The moving average should give you trade management ideas, which a lot of you having fear you click out too early, to help you understand, you know what, Steve, I can't figure out those damn levels, but I saw the 50 cross the 200 after a pullback and then continue. That's a clue that maybe you're in level 2 for the day. Okay, you found the peak formation high for the day in this example, and you were able to exploit it and trade it. You were able to catch your entry right there. It just so happened that it made the M or V top at the same time it crossed over. Does that always happen? Of course not. Sometimes there's a lot further separation away from the averages before it fires back through. But let's just say in this example that you got the crossover the same time. Okay, now, you know what, Steve, I'm in this trade, and that W scares the shit out of me. I usually get out and give all my money back, and then I watch it fall for another 200 pips. Well, as long as there's no closes inside the mustard, you're good. If the dealer starts to get expansion between the averages, and then you notice that the 50 and the 200 cross over, perhaps you're in level 2 for the day. You should think there's one more push coming. Start to realize I should be able to get one more push out of these guys. Then I noticed that price has been dropping, but all of a sudden it got choppy. It got choppy and it's not going any further. And the low of the day has been established on the big board. Price is at 31.07 right now for the low, and it hasn't moved off of that number in quite some time. And I noticed that price is trading sideways, and the dealer is trading slightly off of 31.07, maybe at 31.15 by 18, and he's not really moving. But the board's flickering a lot. Perhaps that's the end of the run, confirmed by a collapsing of the averages starting to come back together. These are the things that you're supposed to do with the TDI, the moving average, the big board. These are what you're supposed to be looking for. These are the nuances that are going to make you smarter and better than every other trader out there, because they don't understand these things, that the dealer works the high and low and beats the crap out of people in between in order for him to pocket their money. Understanding these things, separation and space between the averages, price action, separating away from the mustard and the ketchup, will help you to understand that I don't need to get out of this trade yet. It's still good. The dealer is separated away from there. These are the things that are going to give you confidence by working with the segments individually. I notice TDI stays above or below the green line or stays outside the bands for a level or two. I notice that the averages happen to fan out and cross the 50 or the 200. price crosses the 50 or the 200 and makes a pullback and then drops, I'm not going to fall for that shit anymore and close my trade when it makes its way back towards the 50 because it's a trap. I've been able to identify the high of the day and take a short off of that level. I'm not going to fall for it when the dealer spikes back above the 50 and then comes right back below. I ain't falling for that crap anymore. As long as the dealer doesn't break the high again or break the low again against my position, I'm good. And if 2 hours go by and I'm not in enough profit to move to break even, unless a second leg has been issued or a third leg has been issued, I'm going to scratch that trade out and save my money. That's what the point of this drill or these things are. Okay, that's how you use them to your advantage. I know moving averages don't matter in the scheme of what I teach in the price action, but they are a good tool for trade management. And you're going to learn this week how to do it because we're going to take everything off the chart and work the averages. Okay? It's part of the drills for the week. All right. Look exactly what's going on here in this example. We're using a line chart to demonstrate price on the close. Look how he fakes. Look what's going on here. Okay? Isn't that an M? Okay? But look what he did. He faked to the mayonnaise and pulled back. He throws an M pattern, but we know that we're in an uptrend. He comes back slightly below the mayonnaise and pulls away. Isn't this little baby, don't you see this little baby thing right here? Look at that. And then look at this. Look at that right there. Just below the 4 hour. Okay, look at this right here. Just below the 4 hour. I can't say this enough, so I'm going to say it one more time. It's the same shit every day, different price point in the right-hand margin. You could care less if Euro's at 131.07 or if Euro's at 118.16. I could care less because the dealer has been doing, he does these exact same moves on every single chart, every single day. It's, you take down, you break the little segment down and you realize, okay, he hit the low. He came near the low, didn't break it. And in this little period, he set the low here, and he came near the low and didn't break it again. Okay? He set the high and didn't break the high again. And he did it by grabbing the orders or the stop loss orders that were slightly above the blue tracer, which obviously I'm not going to get to tonight. We'll pick it up next week. I have to say it one more time. Thank you, Jerry. It's all he's got. That's all the dealer has. What can he do? Hit the stops up or down, make a run, go into consolidation. That's it. That's all the guy has. If that's all he has and you could get the deeper understanding, you're going to be able to beat the dealer on a regular basis. You use the averages and the tools that I provided for you. Not like I'm inventing them. I just collected them together and realized that, man, the market makers make their move at these levels. If you realize that and don't fall for the tricks, and nothing crushes me more when somebody asks me, hey, can I take that 513 crossover? You should already be in off the W formation if it's to the upside, and you should already be short on the M formation as to the downside. The 513 crossover can give you confirmation that you've got the peak formation high. Why? Because what is a moving average? On average, if it crosses to the downside, on average, price is falling. On average, price is rising. That is a confirmation tool to understand that, you know what, I think I caught the high of the day. I'm going to hang with this trade for a while. Right, from Trading Places, I believe we can hang out for a little while. Billy Ray Valentine. Some of you get it, some of you don't. Okay, if you haven't, go watch the movie. Okay, so they fake to the averages, they fake to the pivots, they fake to the support and resistance point. Why? Because everyone I ever met that trades talks about support and resistance as the end-all be-all. Well, I'm telling you, the end-all, be-all is how they work the high and how they work the low. That's our end-all, be-all together as a group. Billy Ray Valentine, Capricorn. Love it. Anyway, what's the best resistance of the day? The high. What's the best support of the day? The low. Because the dealer says not another tenth of a pip. Used to be able to say pip. Now it's tenths of a pip. Not another pip today. That's it. I am at 30.36, and I don't want another pip today. There's too many orders above there. I can't stand to go above that. It's going to hurt my book. It's going to hurt our open float. If we pick up the orders above 36, it's going to hurt our open float. So now, the high of the day is the best resistance there is. If it's the true high, and you think about this for a minute, if the dealer's at 36 and you put a stop at 37, I don't know if I saw Lou here, I don't know if he's still here. He ain't coming back, baby. There he is, Lou. He ain't coming back, baby. If they extend the 36 level, it wasn't the high of the day, was it? No. You guessed wrong. Big deal. They hit it again and they take it to 45. Okay? He's going to fall off this area or rise off this area. It's his job. It's your job to identify those price points and to exploit them. Okay? All right. Here it is again, level stuff. Look, boom, boom. Level 2, there's your crossover. Level 3, look, he goes to the mayonnaise. That almost looks like too much mustard on there. Hold on. Looks like Grey Poupon. Let me get another color. Excuse me, sir. Is that Grey Poupon you're eating? All right. Some of you remember that. Man, same color. White. Okay, look. That ain't working either. All right, we'll figure it out. Look. Peak formation, pullback, 50, 513 crossover. Price falls below the 50. Ends the day rattling around in between. Okay? But you can see the levels as he comes back towards the mayonnaise. Remember what I said about, hold on, clean this off. If the averages are separated out, if the 200 was up here at the beginning of the cycle, I would expect the dealer to penetrate both averages. But this is the example where at the end of the day, the end of the run, the mayonnaise happened to be laying there. The dealer made his drop into the mayonnaise, faked past it, and then reversed off of it. Okay? All right. Let's see where we're at. Okay. Previous day high-low, it's a good place to end. I'll pick this up exactly where we left off next week. It's 25 after. I'm going to roll back through a couple of questions, and then I'll pick up next week. We're going to do blue tracer, ADR high-low, and strike zones, and a couple other things that I have lined up. What I'm trying to do is this. I'm trying to write the whole class out, and where it ends, and then I'll just pick up next week where I left off. Okay? If you're not in the monitor drawing, send me your name. I'll drop it in the bowl, seal it so my son doesn't knock all the pieces of paper all over the place. That's why I have to put saran wrap on the top every week. I throw the new names in there and reseal it because the bowl's on my desk and he can't stand it. He's got to touch it. It's his job. Anyway, that's what I tell my wife. Why did he do that? It's his job. He's a baby. That's what he does. You ever heard the thing, you know, the frog and the scorpion? Right? The frog, I'll make it really quick. The scorpion needs a ride across the river. Yep, some people know it. And the scorpion begs the frog for a ride, and the frog goes, no way, I can't give you a ride, man. You're going to jump on my back and sting me. I promise I won't sting you. I promise. I need a ride really bad. I promise I won't sting you. The frog trusts him. The scorpion gets on his back. Halfway across the river, the scorpion stings the frog, and he goes, you don't understand. We're both going to die now. Why did you do it? It's a scorpion. It's what I do, man. Okay, how does that relate to this? I'm a market maker. It's what I do. I got to hit the stops. I got to take your money. I'm a market maker. I'm a scorpion. It's what I do. Okay? So now, okay, if you want to monitor, don't send me your name again. All right? That's not right. I've taken you out of the bowl and thrown you into the garbage can. No offense, but you're out. Okay. All right, man, look. I had a bunch of other stuff to cover, but I just wrote it all. So let me go to the very last slide of homework, and let's talk about what you got to do for the week, man. All right? Okay. Here's what I want you to do this week. Create a template with just moving averages. Wait a minute. I think there's another one before this. Hold on. All right, here you go. Homework for the week. Steve, you're a jerk. Wait a minute. My wife wrote this slide, by the way. I think she was talking about I forgot to take the trash out. No. Steve, you're a jerk. How come you never show us how to set up the homework charts? By default, you're learning how to use the MT4 platform. Every time you go in there and force yourself to do something outside the box, you have learned something. That's why I'm a jerk. Last week, I asked you to hit F10, set up the big board, play around with it. And then I went in the forum, and some people answered for other people. I want you to learn how to use the platform. That's part of the boot camp training. By making you do stuff outside the box, you have to learn how to work the platform. And if you can't figure out how to work the platform, assert yourself and teach yourself by using YouTube, instruction manuals that are online. Make yourself learn. Okay? No one taught me how to use MT4. I taught myself. And I want the same for you. Once you learn it, no one can ever take it away from you. Okay? All right, so I want you to learn how to use the platform. It's a very important part. And if you're not using MT4, big deal. TradeStation, eSignal, I don't care. But you got to know how to use this stuff. Okay? All right. R&D for the week this week. Create a template with just moving averages. Go in there, right-click on properties, figure out a way to get the price action off there, and make a line chart based on the close. Remove everything else from the chart. Everything. I want you to find moving average only entries and exits in a demo account. Okay? Take everything off your chart, strip it down clean. All I want you to have is moving averages. And by the way, when I taught in Dubai, people made a line chart. If you can make the line chart match your background, use a line chart and make it lighter gray, or if you're using black, make it light gray, just so you can barely see it. I want you to try to see what the averages are doing. You're looking for the spaghetti effect, where they come together, where they make a formation and then they start to separate like this. Okay? And then you're looking for them to come back together and cross over and then go into spaghetti. You're looking for the pattern in the averages. Yes, no price, Helen. No price. And I want you to trade just off of those. Think about this for a minute. Wax on, wax off. All right? Another movie reference. Think about this. You've done TDI only action. You've done the big board. Some of you haven't. Some of you have. Some of you wrote me and said, I hate the big board. I'm never doing it again. Someone wrote big board equals big mess. Thought that was pretty good. Okay, so listen. You're looking at TDI only. You're looking at how the dealer handles the high and low and how he breaks that high and low and how he sits on that high and low and pulls away from it. Okay? Now you're going to integrate the moving averages into this by trading moving average only. Think how strong you are going to be. You're going to trade strong when we're done and all these things are put back together. Yes, Derek. He was a great man. He died. He's a good friend of mine, too. Think about when you break all this stuff down and you put all this stuff back together. When you put the TDI, price action, moving average channels, how the dealer handles the high and low, all back together. Think about this. You're going to be very strong in your trade decisions, your trade management, your entries, your exits, the things that are going to make you a better trader. So that's what the purpose of this time together is. Now, I can't believe we've been together 7 weeks. And listen, I can't say this enough. It's never too late to get in there and roll up your sleeves and do what it takes. Okay? I want you to try to observe the interactions of the EMAs with the tracer, ADR, and pivot levels. We were supposed to get to those things. Just do a plain chart. We'll do that drill next week. We'll add some things on the chart. Okay. Last bullet point I want to make. The high-low board, this moving average, the TDI stuff, the drill is very frustrating. It's supposed to be. If it was easy, you would have never had to take my class. But remember this, it's frustrating for a reason. So what? It's demo. I had someone write me an email and said, I took 2 trades, got stopped out, and that's it. I quit. Shame on you. You get in there and you keep trading demo until you can identify a signal, a moving average channel, a collapse inside, averages turning into spaghetti. Those are the things you're looking for. Okay? You're looking for the things that will help you manage the trade, clarify your entries. You're looking for the reasons to hold or fold in a trade. These indicators indicate those things to you. It's demo. Who gives a crap if you get stopped out 2 times? Who cares? Don't do it with real money and then write me in and go, oh, I don't know what happened. I took a moving average across and it didn't work. I want you to learn how to individually use the components of the chart. Next week we're going to add ADR, pivot levels. Just think when you start to tie all this crap back together. Right now I've got you working with each individual section of the indicator list. I'm going through the whole list, man. We're going to add ADR next week. We're going to add the blue tracer. Think about how tying all these things together is going to make you stronger as a trader. When you go to the gym, do you work your whole body in 30 minutes and go home? Well, some people do. But when you go to the gym, you work buys and tries. The next day you work shoulders and back. The next day you work chest. The next day you work legs, and you start over. So right now, we did chest, shoulders, and back, buys and tries. We're working our legs this week. By breaking the individual body parts down or template parts down is going to make you stronger as a trader, and it's going to make you more confident and more decisive in your actions. That's the point here. Okay? So basically, we're working out. I'm trying to make you ready for P90X. Yes, Laurent, correct. All right? Okay, man. Let's see. Yep. Coke, thank you. Thanks, Steve. Another grateful session. Great. Thank you, guys. All right. All right, look, man. It's 8:35. I kept you over. 22% for the month of April. Fantastic. Fantastic, fantastic. Love to hear stuff like that. Dave, I agree, but that's not for everyone. Keenan, thank you, man. Thank you, Jerry, Brenda. Lou, nice to see you, brother. They ain't coming back, baby. Adam, nice to see you in here, man. Arnie, hope you're doing okay. Paul, John, glad you're here. All right, man. I am going to bail. Can't wait to see you guys in New Jersey. I will see you next Sunday, 6:30. We're on next Sunday, right? Let me look at the calendar. Yep. We're good for the next 3 weeks, and then I think it's Memorial Day, and then I got the class, and then we'll do a couple more boot camps, and then I'll be in New Jersey. Okay, man. Jeff, nice to see you, buddy. Can't wait to see you guys up there. All right, good night, everybody. Thanks for have a good week trading. Keep me posted. Send me emails. Let me know what's going on. Love you guys. Good night.